July's weaker than expected jobs report fueled fears the Fed's focus on fighting inflation has come at the cost of the labor market's health. What's more, job openings and the hiring rate have both slowed considerably, indicating the tight labor market that made the Great Resignation possible is a thing of the past. Joining me now is Noah Yosif, American Staffing Association chief economist and head of research. Noah, thank you for being here. Appreciate it. So first of all, just give us big picture what you're seeing from where you sit and in the staffing realm particularly.
Absolutely, Julie. So markets clearly had a panic attack over July's jobs numbers. However, once they took a step back to look at the broader picture, they were able to course correct. July's numbers were certainly not great. However, in the bigger picture, the labor market is still considerably healthy. A lot of last week's concerns centered around the SAM rule, specifically a labor market indicator that has so far correctly predicted every recession based on changes within the unemployment rate. However, what folks don't realize is that the unemployment rate is still at a very healthy level. During the last economic expansion, the longest on record, unemployment trended at an average of 6.3%. In the last 3 years, before we had the coronavirus pandemic, unemployment trended at about 4%. In between the dot-com bubble and the Great Recession, unemployment trended at 5.2%. So unemployment is generally trending at a very healthy level. But looking beyond the unemployment rate, we're also seeing other indications of a very healthy labor market. Labor force participation is still much higher than it was at the pre-pandemic level. In addition, we're seeing that productivity amongst workers is also increasing as a result of higher borrowing costs through monetary policy. And finally, wages are also accelerating faster than inflation. So when looking at the big picture, we're seeing that the labor market is fairly healthy. And what makes things even more optimistic from my side is looking at the staffing industry, which has typically been a leading indicator of broader labor market activity. Right now, what we're seeing is that the staffing industry has hit a plateau in terms of employment. So we're seeing declines within the staffing industry get smaller and smaller every month. And because of that, there is good reason to believe that the labor market might also hit a very similar plateau from which it could rebound once interest rates begin to decelerate.
So, okay, so just to put a fine point on that last point there, so you say the staffing industry is a leading indicator and you have been seeing declining number of positions posted or needed, but those declines are getting smaller, which is a positive. So, and how long ago did that phenomenon begin?
Well, that phenomenon has begun for much of 2024. We have seen that the BLS has initially come out with more severe estimates of declines within staffing employment, but revisions have largely been positive, sometimes going 40,000 jobs higher than what was initially expected. Similarly, looking at private indicators of the health of the staffing industry, such as the ASA Weekly Staffing Index, we have also seen a plateau in overall employment relative to the declines that we saw in 2023, in which the industry was coming down off of highs that it had experienced during the Great Resignation and the benefits that it had of greater labor churn.
No, on an anecdotal basis, I've still been hearing about people job hopping, right? And I'm wondering if that's something that you're seeing reflected in your data, or if there is starting to be a slowing of that phenomenon.
There's absolutely starting to be a slowdown of that at an aggregate level. What we're seeing is that there is less labor churn because there are fewer sectors that are contributing to the majority of non-farm payroll gains, sectors such as healthcare, government services, et cetera. And so therefore, within those particular sectors, we are seeing a significant amount of labor churn at healthy levels that we saw even in 2023. However, at an aggregate level, labor churn is slowing down because employers are not looking to hire as much and employees are less confident about their prospects on the job market. However, when it comes to the staffing industry, employers overall still see that the staffing industry plays a very valuable niche in being able to provide alternative work arrangements and being able to supplement their existing productivity and efficacy initiatives. And so therefore, what we're seeing right now in the staffing industry is more of a lull in employment that is going to rebound once we see that borrowing costs are alleviated due to an increase or a decrease in interest rates.
Noah, thanks very much. Appreciate it.
Thanks, Julie.